Good morning. This is Robert Kaars Sijpesteijn bringing you this morning's market update. Further reporting came out yesterday, pushing the tech sector higher off the back of Facebook's impressive results. A strong performance from Microsoft's cloud computing division helped send shares in the world's largest software company up more than 6% in aftermarket trading. Tied in with rise in oil prices, all US indexes moved upwards. The US 500 added 9 points to close on 1,888.60. The US Tech 100 gained 5 points to close on 4,146.43, and the Wall Street gained 163 points to close on 16,062. In comparison to Microsoft, Amazon shares tumbled more than 12% in after-hours trading as the company missed profit expectations. Despite reporting income had more than doubled year-on-year in the final quarter of 2015 to $482 million from $214 million, or $1 per share from 45 cents per share. However, this was significantly wide of analysts' expectations of $1.56 per share. Sales of Amazon Web Services, its cloud hosting business, climbed again, continuing the trend from last quarter, from $1.42 billion to $2.41 billion. Spending in this division was up to $1.7 billion from $1.2 billion in the third quarter of 2015. The firm expects net sales to be between $26.5 billion and $29 billion this quarter, representing growth of between 17% and 28% compared with the first quarter of 2015. Amazon has been ramping up its presence in the UK over the last 6 months. In November 2015, the company launched its pantry service, offering Amazon Prime customers next-day delivery on over 4,000 everyday essentials, including major food and drink brands, household supplies, and health and beauty. The group has also put more traditional grocery brands on edge with the rollout of Amazon Fresh, which launched in London and Birmingham last October under the Amazon Prime Now banner. The Fresh service offers delivery of kitchen essentials within an hour of ordering. Amazon recently revealed that it is to create 2,500 new jobs in the UK. Looking at commodities, gold declined yesterday, dropping $11 to close on $1,114.30. Brent crude, however, rallied, gaining $1.53 to close on $35.38 a barrel. Yesterday, Russia's energy minister said he is ready to meet OPEC members to discuss oil production cuts, triggering a violent rally in crude futures as hedge funds scrambled to cover their bets on falling prices. Brent crude oil futures jumped as much as 8% to near $36 a barrel after Alexander Novak said Russia would meet the oil producers' cartel next month. OPEC has so far made no announcement of a meeting in February, but some of the group's most cash-strapped members, including Venezuela and Nigeria, have been pushing for emergency talks after oil price dropped to a 12-year low of $27 a barrel last week. Any deal would need the backing of Saudi Arabia, the cartel de facto leader, which has expressed doubts in the past about Russia's willingness and ability to lower output. Still, the comments from Mr. Novak are the latest sign that Russia may consider reversing its opposition to cutting production as the pain inflicted by falling prices has intensified, with oil's drop to below $30 a barrel at the start of 2016. A cut of 5% by Russia and OPEC would remove more than 2 million barrels a day of production and help rebalance an oversupplied market. In Europe, the Germany 30 had a late-day decline, closing 84 points lower on 9,655. The UK 100, however, added value again for the third straight day, closing 20 points higher on 5,937. A brief look at currencies. In the past month, sterling has lost 3.5% against the dollar and the euro. It has fallen more than 6% against the currencies of Britain's main trading partners since mid-November. The recent sell-off is partly due to signals that UK policymakers are now unlikely to follow the lead of US Federal Reserve in raising interest rates soon. The UK's persistently large current account deficit also makes sterling vulnerable during market turbulence of the kind recently triggered by China's slowdown. Moreover, the latest data confirm that Britain's recovery has slowed as some of the Eurozone's weakest economies show signs of picking up. tempering the pound's appeal relative to the euro. Crucially, though sterling has dropped in tandem with a sharp rise in the cost of insuring UK sovereign debt against default, speculators are adding to bets that currency will fall further. This suggests that investors are starting to act on fears that Britain could vote as early as this summer to leave the EU. The exchange rate will become more volatile in the run-up to the Brexit referendum. In the event of a vote to leave the EU, it could take a bigger hit, especially if the resulting uncertainty were to lead foreign investors to pull out of the country and British citizens to move some of their money abroad. Mark Carney, the Bank of England governor, this week underlined that Britain was relying on the kindness of strangers in running a current account deficit equivalent to 4% or 4.5% of national income, which it must finance either by borrowing or by attracting investment from abroad. In today's corporate news, BT has signed a £100 million deal with BT to replace Vodafone as its broadcast network provider. James Murdoch is to return as chairman of Sky, with Martin Gilbert as deputy chairman, and Rolls-Royce is to reveal senior management job cuts. Today's economic data in focus: at 9 a.m. Europe released its private loans. At 10 a.m. Europe is releasing consumer price index. At 1:30 p.m. in the US, GDP will be released, and at 2 p.m. Germany will release its GDP. That's all for this morning's market update. Thank you and goodbye.